everyone, and thank you for joining us today for LIFO Pro's Beginner's Guide to LIFO webinar. My name is Alex Howe, and I am today's moderator here on the LIFO Pro side. Your presenter today is going to be Bob Richardson, the VP of LIFO Pro. And as everybody is joining in here, if anybody has any issues with audio or anything, please just jump into the chat and let us know. We are going to be doing some poll questions as we go along, so make sure that you're staying in tune with the presentation. We'll be dropping those about every 10 to 15 minutes. And we hope that everybody enjoys their time today.
Thank you, Alex. My name's Bob Richardson, VP of LIFO Pro. We offer turnkey outsourcing solutions in LIFO software. So we're a firm that's dedicated exclusively to LIFO. We've been in business for about 30 years. Our founder was a former Touche, now Deloitte auditor back in the 80s, and his experience and time with clients that were on LIFO gave him the background to understand nuances, the complicated nature of LIFO, and the eventual idea to automate LIFO calculations using software. So 30 years later, we continue to develop and maintain licensed LIFO Pro software, but we also provide turnkey outsourcing solutions to hundreds of clients of all sizes, industries, and we've got a huge client base where turnkey outsourcing solutions is our most predominant offering provided as of 2022. So today, before I jump into this, we're covering a lot. Done many webinars as of today with the inflation being as high as it is. What this webinar is intended to do is allow, say you're a company that's not on LIFO, you'd like to learn more about how it works, that we'll cover that. But we'll also cover, if you were to elect LIFO, how do the mechanics of LIFO exactly work, and we'll show how you would go through the steps of making a LIFO calculation. But what we'll also do is, since we're anticipating many companies, people that are on this call and webinar today are with companies that are on LIFO but could be good candidates and are considering to elect, talking about, are you really good at really a good candidate or not? What could we be looking for prior to making a final decision to get on LIFO? What are the logistics? What are the things we should be looking at? Pros, cons, risks, rewards, things like that. We'll discuss that on the back end. So let's jump right into it because we have a lot to cover. So the first slide talks about why use LIFO. Well, there's a tax benefit. So if you want to think, well, what's the carrot on the stick for companies going on to LIFO? Well, there's material long-term tax deferral and savings that you can accomplish by electing and using LIFO. And it's not just a one-time tax benefit or timing difference that you may think of as, okay, with depreciation, you have more tax deferral when you're using accelerated depreciation for tax purposes and straight line depreciation for, say, for book or financial reporting. That this is something that you're planning on staying on LIFO when you get on LIFO. That's how most companies look at this. But with consistently rising costs, so if you're a good LIFO candidate, that's the camp that you're going to be in. That this isn't going just to be a one-time benefit. This is something that can, over a long period of time, become a very material portion of your balance sheet. We have clients that they have a LIFO reserve that's now half of what their total inventory balance is. So although LIFO may represent a small portion of the balance sheet at the beginning, if you were to look at LIFO as a long-term tax savings or deferral tool, it's something that can be very, very beneficial over a long period of time. And this isn't a controversial issue. It's something that the tax courts have gone as far to say that income is more clearly reflected by matching current costs with current revenues. That's how they look at LIFO, and it's not going away. Congress isn't going to repeal LIFO. We're members of a LIFO lobbying group that they're kind of keeping a pulse on Capitol Hill to keep track of any legislative developments or concerns that could cause or warrant the possibility of LIFO going away. And as of today, there are no efforts to repeal LIFO. And more importantly, something as we go through this training today is to just realize and let it sink in that this isn't something that you're just going to use as a tax loophole or an incentive. It's something that you have to use on your financial statements as well. So although LIFO, you're getting onto LIFO typically to obtain tax deferral or savings or a benefit, but it's something that from a GAAP perspective, you could look at it as it's really a more conservative measure of income compared to, say, FIFO or average costs, because with LIFO, you're going to have lower income and you're kind of achieving this whole idea of conservatism, overstate expenses, understate income, that you achieve this true principle of conservatism that's important on the accounting side of things. So mechanically speaking, with knowing that you're not just using it as a tax deferral tool, and some even consider it to be a permanent form of savings, that, hey, I'm going to get on LIFO, we're staying on LIFO, and we have many, many clients, they've been on LIFO for 4, 5, even 6 decades, that it can be a permanent form of savings. But just logistically speaking, how does this work? Well, when you have inflation and you have LIFO, you're going to have higher after-tax cash flow. Well, why is that? Well, you're going to have an ending inventory value that's transferred with inflation from the balance sheet over to the income statement in the form of cost of goods sold. So what that leaves you with is lower pre-tax income and tax liability. So LIFO is in fact something that isn't just a tax loophole. It's something that, although you'll show lower reported income on your financial statements, what the true benefit is on your statement of cash flows, you will have lower tax liability and better cash flow. So there's a lot of misconceptions out there. I was in college accounting and remember being taught that you've got purchases, you've got sales. If you're going to use LIFO, all of a sudden the physical flow of goods will now have to be tracked on a LIFO basis. What they don't teach or go into deep detail, at least in my college accounting class, was this idea of dollar value LIFO, and the whole idea that most of the undesirable characteristics of LIFO can be avoided altogether by, instead of using specific goods or what's commonly called unit LIFO, instead using dollar value LIFO, which under that method, you're not making a LIFO calculation and tracking the physical flow of goods on a LIFO basis. You're actually just making a calculation outside of your accounting system, say on your own within an Excel file, or say with LIFO Pro Solutions, outsourcing that to a firm where ultimately what you end up doing is making a topside accounting entry, and you're just doing that to record your ending inventory. Say you use FIFO to FIFO from FIFO, to LIFO, and that's just being done to accrue the change in your LIFO reserve. So said another way, your item costs will remain being tracked the same way before going on to LIFO after you go on LIFO. And so it requires no real changes to your accounting system other than adding a subledger account called the LIFO reserve. So on your subledger, you'll have a contra inventory account called the LIFO reserve. And that's the only real true change that will occur. Another misconception, very common, employee compensation and bonuses, that's going to complicate things. Well, even when you're on LIFO, internal management reports can be issued under a FIFO, average cost, specific ID, whatever your current costing method is, you'll continue using that method. And so LIFO will not cause problems, and decision makers, executives, salespeople don't have to be concerned about LIFO affecting their take-home pay, because most of the time, at least the that are clients of ours that we're aware of, they're not including LIFO in that whole equation. Another very common misconception, tax savings from LIFO will be minimal because of high inventory turn or new item rates, or, well, we just don't have as much inventory, or we're working on a just-in-time or lean accounting to reduce inventory. Well, even if any of those things are the case, for the first misconception or objection you may have to LIFO, you'll always measure inflation over a 12-month period. And so if you have turns of 20 times a year or 1 time a year, that turn does not affect your inflation calculation, because for what you have at the end of the year, you're looking at, say, December calendar year end, December 2022 divided by December 2021 inflation. And on the just-in-time or lean accounting practice piece, well, you always have to maintain an adequate base stock. You're always going to have raw materials and to some extent WIP. So as long as you have inventory, it doesn't have to grow substantially over a long period of time for your LIFO reserve to continue increasing. We have companies where their inventory drops, but they had inflation and their LIFO reserve increases. So those are one of the 3 very common misconceptions. One I'll leave you with prior to Alex probably putting us off to our first poll question is, well, internal costs don't have to be used to measure LIFO inflation. In fact, the majority of our clients are using what's called an external index, or the Bureau of Labor Statistics consumer or producer price indexes, where you rely on a government source, and rather than leveraging your internal product unit or, say, standard costs, you're using the government BLS CPI or PPIs.
Alrighty, and before we move on, we're going to go ahead and launch our first poll question here. The question is, what does LIFO stand for? Fantastic. Looks like we have about 90% already voted there, so we will go ahead and move along. And as 97% of you did say, last in, first out inventory.
All right, well, sounds like got some knowledgeable people on the call today, or they're paying attention here. So moving on, this last conception gets its own slide of its own. There are probably other misconceptions that we didn't cover, but this one's important enough to warrant its own slide. So if I've had maybe 100, 200 discovery calls over the last year or two talking about electing LIFO with companies that are considering adopting, one of the most predominant ones is this idea that, well, we're at the peak right now, but our inventory is going to drop next year. And so we feel like this just isn't a good fit for us because we'd have to give back so much, or such a substantial portion of our LIFO reserve back once our inventory drops, that it's just not a good fit. Well, the clarifications here are, 1, in most cases, material LIFO recapture, meaning say you have $1 million LIFO reserve in year 1 and you have to give $800,000 back next year. So that sort of situation doesn't occur unless you have either substantial deflation or a very substantial inventory liquidation. And I know the numbers or amounts are small on the slide, but what we're showing here is that in an example of, let's say you've got 28 million of inventory in the election year, which was 2021 in this case. So this projections report is saying, here's what the LIFO reserve change amounts are, increases being in green, decreases obviously in red, that depending on what your inflation is from left to right and your inventory balance for the following or next year end, which we're calling 2022 on this slide, what would our LIFO reserve change be? So let's say it drops down to $18 million. So that's a $10 million decrease year over year. So we're talking a real big decrease in your LIFO or excuse me, decrease in your current versus prior year inventory at cost. Well, if you had 1% inflation, as this table is showing, you'd still have an $80,000 increase to your LIFO reserve, which we call LIFO expense as an increase. So it would take a massive decrease in your inventories at cost to have any meaningful LIFO recapture. I mean, you wouldn't have $1 million of LIFO income until you had inventory down to $11 million, which from 28, we're talking 15, close to $20 million of a decrease. You'd have to have lost the majority of your inventories to have any meaningful LIFO recapture. And in this example, you'd still have a $2 million LIFO reserve even after you did decrease under a 1% inflation example. So the key takeaway here is, hey, we can get a big LIFO reserve if we have a lot of inflation in the election year, which most of you will be looking at if you're considering adopting. And unless there's huge deflation, we could have a drop of $1 million, a couple million, say 5, 10, 20% drop, and we wouldn't have to expect to give back most of that in the following year. And then the second clarification is that, and I've kind of displayed it already, that your inventory can drop year over year, but if you have inflation, your LIFO reserve will still increase. And you can see that here, that at the bottom, we're showing, hey, this is the number that you need to hit to maximize your LIFO reserve change. So you top out at anything above 28.3, 28.4 million, as you see, that it's $280,000 change, and it doesn't grow any higher once you get above this amount. It's once you get above this $28.4 million figure, and as you'll see here, at 28 million, you start getting a little bit less LIFO expense, and it starts working its way down to less and less until you hit something that's LIFO income. So this misnomer that your LIFO reserve will never increase when you have a decrease in your inventory, it's just not true. That's not how dollar value LIFO works. So getting into the fun part about all of this, I like to look at LIFO as kind of a three-legged beast, or really our whole goal in our business is to make being on LIFO as simple as possible. So from a perspective of our clients, they're doing very little work compared to what our software is doing, what we do in-house, or if they license our software, there's a lot less work involved with LIFO. But in any event, there are three legs or three parts to LIFO that when you're using dollar value LIFO, you have to, it's inevitable, they have to be done. So the first leg is the inflation calculation. So that means if you're using an internal index, what are my costs this year? What are my costs last year? What is the ultimate inflation for my goods as of the current year end? If you're using an external index, different steps are involved, but what you would ultimately end up doing is using a government index. What does the PPI say for December 2022? And what was the December 2021 PPI? And you're using those indexes to essentially accomplish the same thing. What is your current year inflation rate? So once you've completed that, you have to calculate what's called your LIFO layers. And there's actually two layers. So as I step back, I'll just call them, you have to calculate your layers. And I say it that way because the first layer is called your base year layer, and the second layer is called your LIFO layer. And they both have to be calculated every year. And what you'll end up ultimately doing is making a comparison to say, do I have a new base year and LIFO layer this year, or what you'll commonly hear called an increment or increase, or have I eaten into a prior period or possibly even multiple prior periods layers? And in that case, that would be called a decrement. So once you have determined that, calculated your new layers or calculated the decrements into old layers, you are then able to calculate what's called your LIFO reserve and your LIFO expense or income. And so what those figures represent is the difference between inventory, say at FIFO or average cost. So if you have a $10 million FIFO balance and you calculated that your inventory at LIFO, or your LIFO inventory value, is $8 million. The difference between the two would create a $2 million LIFO reserve. And let's move it forward 1 year. You're now at $11 million at FIFO and $8 million at LIFO. You now have a $3 million LIFO reserve. Well, if you had $2 million last year, that's how you get your LIFO expense or income, which is the change between current and prior year. And in this example, you'd be talking $1 million of LIFO expense. I think we're due for another poll question, right, Alex?
Yes, indeed. Our next poll question is going live now. And the question is, are you with a CPA firm or a company? We're going to leave this poll question live for about 60 seconds. So you have about 45 seconds remaining to answer. Looks like we have about 90% participation. So if anybody else is still on there, you got about 30 seconds to answer your question if you are with a CPA firm or if you're with a company. Alrighty, we are coming down to our last 10 seconds here, and then I'm going to close down this poll question. If you do have any issues answering the poll question, just send a question directly to us or a message in the chat, and I will make sure that you get credit for it. So I'm going to go ahead and close this down now. Thank you guys for participating.
Thank you, Alex. Okay, so we'll get into the finer details of those 3 steps that you have to take to calculate LIFO under a dollar value LIFO approach. So we talked about inflation. You have essentially 2 options when you're making your inflation calculation. So what I thought would be most useful would be to look at some sample LIFO Pro reports. And while doing that, as I think it'll come up on the screen here momentarily. Yeah. So what we have here is, in your inflation calculation, if you're using an internal index, so that's what this screen is showing, a sample internal index calculation, you're ultimately having to pull out of your accounting system 3 key figures. So all items that you're going to include in the scope, but also your quantities on hand, your current year and your prior year or current and prior period item or unit costs or standard costs. So once you have those 3 figures pulled out into, say, an Excel file or a report, what you're going to do is make extensions using the current period's quantities twice against once the current year cost, the prior year cost, and once you make those extensions, you arrive with current and prior year extensions. Now, there's a lot that goes into an internal index inflation calculation because one may ask, well, what do you do with new items? And so if we were to scroll down in this example to row 34, we're looking at a ball valve that, well, we don't have a prior year item cost. So you have to decide, are we going to set the prior year item cost equal to the current year item cost and essentially give it 0 inflation? That is one option, but you have less inflation in a period of rising costs, so you're going to lower your overall inflation index. So in this example, what we did was we reconstructed item cost using the class indexes for the pre-existing items, and so our software automates doing that. And in this example, that ball valve fell in the below grade equipment class. And so using your accounting system's class or hierarchy system, or for in this example, this is an actual client that allowed us to use their data. Their below grade equipment had a current year inflation index of 1.09 for the pre-existing items. So if you were to scroll into our other report that shows after applying the new item treatment, you'll now have the ball valve in the inflation index of 1.09 that we calculated in the inflation by class report on the other Excel sheet. So you have considerations there for new items. A second thing that you have to take a look at is, well, in this example, I forget how many items they had. So there's 20,000, yeah, well over 20,000 unique items. So you inevitably, if you're not selling gold bullion, likely to have the possibility of inflation outliers, data consistency, issues where you want to consider and review and have a way of dealing with those sort of issues. Where did our unit of measure change, or the packaging type change? Did we have a data entry error? Things like that. So under that sort of issue, it could take a lot of time manually reviewing that, but we nonetheless think it's warranted and worth the time looking at, because in this example, there were items where, okay, a 0.26 index would infer that you had 75% deflation. So in a year where this company's example, they had 6 or 7% inflation, you want to review those outliers possibly, right? You want to establish criteria to just systematically on an ongoing basis. And in this example, we set a threshold at 30%. And the treatment that the client decided to end up applying was anything that had more than 30% inflation or deflation, we're going to reconstruct the cost for those items because we think that it has to be an anomaly, an error, something that's just, it's not right. That under this approach, we used the reconstructed costs where, once again, like we did for the new items, used the pre-existing inflation indexes by class for the non-exception items and applied the inflation rates for anything that was an exception or had greater than 30% inflation. So there's a lot to look at. You have to think, what are we going to do with new items? What are we going to do with items that have inflation that falls outside of our, what we're calling an outlier criteria? So those are some of the finer details of an internal index calculation. And I'll scroll back and forth here. But what you're ultimately driving at is, what is our current year index? And so that's what the reports that we've been showing here ultimately ended up doing, is that when you make those extensions of current costs, prior costs, and the current quantities, you arrive at a current year inflation index. And so your last step in your inflation calculation, once you end up calculating a current year index, is to calculate a cumulative index. In your first year on LIFO, you'll end up having something where you're going to have a current year and cumulative index that equals one another, but on an ongoing basis, you take your prior year's cumulative index times this year's current year inflation index, and so you're updating your cumulative inflation index every year. Under an external index approach, it's a completely different look that you're ending up applying. So what you end up doing is government indexes, and what we're going to be showing on the screen here now. So it's the same company and product mix, just using a different approach. Instead of using your internal costs, what has been done here, this is one of our report packages as well, is that BLS categories were assigned by dollar, where the same goods were assigned a specific BLS category. So you had plastics, pipes, and this company was a convenience store equipment supplier. So where they had a lot of their dollars were in measuring and dispensing pumps. That for all of their goods that were on hand, a BLS category had to be assigned. So once you do that, as seen on the screen here now, is that you're getting an accounting of what are my dollars by BLS category at cost, at say FIFO or average cost. And then the next step would be to go and calculate what's called category inflation indexes. And so under this approach, what you end up doing is calculate a current and prior year PPI, or use the current and prior year PPI to calculate those category inflation indexes. So in the example of the plastics pipe this year, which we don't have December 2022 indexes yet since they haven't been released, so we used year to date, the October 22 divided by December 21 index to arrive at this 1.10 or 10% inflation for the plastics pipe. So that's how, under what we call the IPIC method, IPIC, inventory price index computation, that's how you calculate category inflation indexes. But what you ultimately end up arriving at is a weighted average pool index. So for this example, you're looking at on pool 3 for this company, you're taking the sum of your dollars at FIFO or average cost and dividing it by the sum of what's called your harmonic dollars weighted quotients, which is arrived at by dividing your FIFO dollars by your category inflation indexes by PPI. And so when you divide the sum of those figures, similar to kind of how you take the sum of your current and prior year extensions under an internal index, you end up dividing those two figures, say your total FIFO divided by your total harmonic dollars weighted quotient. And in this example for pool 3, you had 1.14 or a 14% inflation rate. So that's how under IPIC you're going to calculate inflation. I've now displayed and illustrated how you do it under either inflation measurement source. I'll kick it back to Alex to ask our next poll question that I believe we're due for.
Alrighty, I'm going to launch our next poll question here. The question is, are you currently on LIFO? This one should be nice and easy. We're going to leave this one open for another minute if necessary, but it's looking like we're getting answers flooding in here. Are you currently on LIFO? And if you have any questions for the presenter, feel free to jump into the chat box or the questions box and send them. I am trying to respond as Bob is presenting here. Got about 15 more seconds to answer the question, are you currently on LIFO? Alrighty, thank you all for your participation on that one.
Thank you, Alex. And moving back to where we're talking about dollar value LIFO calculations. So we've completed the 2 of the 3 legs that I started explaining earlier. Ultimately, what happens next is, do I have an increase? Do I have a decrease? So if you have an increase, you're going to create a new layer. If you have a decrease, you're going to erode into a prior period's layer. To make this easier to kind of go through the steps, I've decided to share here today one of LIFO Pro's reports that if you use our software, you have access to these reports and it automates the calculation. If you outsource the calculation to us, you get a PDF report package like the one that I'm displaying now. But as it relates to looking at the mechanics of all of this, once you've completed the inflation calculation, the next thing you'll do is determine whether you have an increase or a decrease, and that's accomplished by calculating your current year inventory balance at base. And so you arrive at that calculation by taking your inventory, say you're using FIFO, takes that dollar amount and divide it by your current year cumulative index. And so as you can see here, you divide row 7 by row 10, and in the pool 1 case, you arrive at a $9.3 million current year inventory at base year cost. Over here in pool 2, you had a $4.3 million base year cost. Why I'm pointing out 2 different pools is pool 1, here we had a decrease or a decrement. Pool 2, we had an increase or an increment. So under both approaches, you still have to continue chugging on and make additional calculations since we have now calculated our base year layers or decrements, but you have to take a second step, as I explained earlier, to calculate a LIFO increment or decrement. And the math is different, where if you have a decrement, you end up calculating, as you see here, row 13 times row 14 to calculate your decrement, or excuse me, your increment, as you would do here for the metals and metal products pool. Whereas if you have a decrement, you end up having some more complicated LIFO math that goes into calculating that decrement. So as we see here at the very bottom, what you end up doing is calculating the current year cumulative deflator index minus the average index of your layers eroded to develop an index that when you multiply this amount times your decrease at base year cost, you end up arriving at a $260,000 decrease, as is now shown up here in LIFO cost. So you have varying calculations and formulas essentially that you end up having to use to calculate an increment versus a decrement. It's often where LIFO calculation errors occur because decrement errors are very common. And when you get into a situation where you say eat into multiple prior periods LIFO layers, you're all of a sudden forced to use different cumulative indexes, where, as you can see here, you're using a cumulative index of 1.14 to calculate the erosion or the decrement for 2021, whereas for the 2020 decrement, where you've ate into a second layer, it's using a completely different index. So that's how the calculation of base year costs ultimately work. We could talk about base year and LIFO layer calculations for probably a full hour, but we've got a lot to cover today. So we'll continue on and talk about the last leg of your LIFO calculation, which ends up being, well, what is my LIFO reserve? Well, taking the previous two steps and putting it all together, what you'll ultimately end up doing is calculating your LIFO reserve, which is the difference between inventory at cost and inventory at LIFO. So you'll end up arriving at an increase in your LIFO reserve. You'll have what we call LIFO expense if you have an increase. Whereas if you're going to have or had a decrease in your LIFO reserve, that's called LIFO income. So what ultimately ends up happening is if your LIFO reserve is increased, you're going to have one component that's going into your LIFO reserve change. So as this slide was showing, you're going to have one or two components that goes into the LIFO reserve change being calculated. So as we're showing on the bottom of the screen here, okay, pools 1 and pool 3 had a decrement. So they had two components that calculate your LIFO reserve change, where you had current year LIFO expense that occurred as a result of inflation, but you also had LIFO income created from layer erosions or decrements. But if you do not have a decrease, if you had an increment, there is no layer erosion component that goes into factoring what was my LIFO reserve change. That, as you can see, you took last year's FIFO times this year's inflation rate, and you got 270 grand of LIFO reserve increase. So layer erosions didn't play into the LIFO reserve change for pool 2, but for pools 1 and 3, it did factor into it. You had a bigger layer erosion income, but what you'll ultimately end up having is, if you do have a decrement, a multi-faceted component that you take the result of those two components and combine them to get your ultimate LIFO reserve change of 5.4 or $5.5 million. So there's a lot of pluses and minuses that I've kind of shown here, but the key takeaway is that you're taking FIFO minus LIFO to get your LIFO reserve, and you're taking your current minus prior year LIFO reserve to calculate your LIFO expense or income, which that would be the amount in this example that you'd be debiting LIFO expense or your cost of goods sold and crediting LIFO reserve. And we show that. That's what the next several slides will talk about very quickly, because mechanically speaking, under dollar value LIFO, if you're doing this in-house, my key takeaway here is inflation, that calculation can be fairly involved. The LIFO layers, if you've been on LIFO for decades, it can also be very involved. Your first year on LIFO, it's not going to be extremely involved to calculate those layers because you only have a base year layer and your current year possible layer. But once you've been on LIFO for many decades, even the layer calculations can become involved. The calculation of inflation can also be involved from the onset. But once that calculation gets made, the mechanics of applying LIFO from accounting perspective, if you're the controller or CFO of a company, is fairly straightforward. So the good news is if you outsource the calculation to us, use our software, it's much simpler, or it can be as simple as possible. All you end up having to do is making a journal entry. So although on your end, from an accounting perspective, you'll see under a FIFO or an average cost basis, you have to get all of this done, and that continues being made under a FIFO or average cost assumption. What happens ultimately is you're making a side calculation using LIFO outside of your accounting system. So maybe you're doing it in an Excel file, maybe you're using our software, outsourcing it to us. What you ultimately end up doing is once you have that LIFO calculation completed is making a journal entry once, say you receive LIFO Pro reports from us showing this summary schedule right here, or in your Excel file within your company, you've arrived at a LIFO reserve of $2.5 million or $3 million, that journal entry would look like it is at the bottom of this slide, where inventory at FIFO was, say, 36 million. At LIFO, it was 33.5. So you would end up debiting cost of goods sold, crediting LIFO reserve for $2.5 million. And as you can see, you've got your FIFO starting point and ending point, less the LIFO reserve is your inventory at LIFO. And you have your LIFO reserve contra account, which represents the difference between LIFO and FIFO. And you've got your cost of goods sold account as well. So from an administrative burden perspective, there will be very little administrative burden if you outsource the calculation to us or use our software. There is some more burden if you calculate LIFO internally, but it's just a journal entry once you get the LIFO calculation done. And there's real benefits where you're talking, in this example, somewhere between $1 million and $1.2 million of tax benefit from LIFO, as you can see on the screen here now. And I'm going to kick it back to Alex as we have another poll question we're due for.
Alrighty, and I have just launched our fourth and final poll question of the webinar. This one is your company's year-end December? We have a lot of companies that we deal with that have a year-end of December, but we also have them all throughout the year and lots in November. Feel free to answer within the next 40 seconds. Is your company's year-end month December? You have about 15 seconds to answer this question. Looks like we have about 85% participation. You have about 10 seconds to get your poll question answered here. Is your company's year-end December? We're going to close things up here. Thanks again for all your participation.
Thank you, Alex. And on the next slide here, what we're looking at are best practices. So I would guess many companies aren't on LIFO that are on this webinar today. Now, best practices, we've got the 5 most important ones here on the screen. I've already talked about dollar value LIFO. What I'll reiterate or just add on to this whole idea that you shouldn't use specific goods or unit LIFO is that you're shortcutting yourself on inflation, or more specifically, your LIFO reserve and tax deferral with specific goods or unit LIFO. So by all means, you should be using dollar value LIFO. None of our clients use unit LIFO because of that. Link chain is the preferred method for your index computation time frame. This year versus last year costs are much simpler to deal with. We have clients that use double extension, but okay, let's say they've been on LIFO for 40 years. Well, now you're calculating, we have a new item, we need the base year cost from 40 years ago. Well, now we need to reconstruct base year costs from 40 years ago. That's time intensive, especially if you have more than one new item, which most do. And then you have the issue of where if we can't even do that, or we don't want to, just don't have the capacity, if we set the new item base year cost to equal the current year cost, you're shortcutting yourself on inflation, because it's obviously 40 years worth of inflation is going to have a meaningful impact on your inflation calculation. Best practice inflation measurement source. The majority of our clients use the IPIC method, external indexes, but oftentimes what you'll do is compare. Let's say the IPIC method is twice as high, or internal indexes is far better inflation, meaning better tax benefits. That companies will often elect and use the method that has the most inflation and tax deferral. The other two are kind of company specific, but I'll touch on pooling. It's just important to understand that the less LIFO pools, the better. If you were to follow IRS regs, you can't necessarily get away with just having a single LIFO pool. You have to follow certain rules depending on if you're a reseller versus a wholesaler or distributor, or even a manufacturer. But if you're using the IPIC method, there's its own pooling method that you establish pools by BLS major groupings. So just remember, we don't want to try to have, we're just not going to go and try to put 100 pools into place because we've got 100 classes and that's what we think we need to do. You need to realize that there's different alternatives and options available, and amongst those various options, you want to go with the approach that arrives or puts you in a position to have the least amount of LIFO pools, because if you have, the more LIFO pools you have, the more potential for future recapture to occur, LIFO income to be created from having multiple pools. Now, towards the end of this presentation, what we're now kind of arriving at, talking about, hey, if you're not on LIFO, you're tuning into this call, we've got 12 minutes left. In the last 10 or 12 minutes, and if we hit all 4 of our pool questions, Alex, we can just devote our time to thinking about, hey, if I'm not on LIFO and I want to figure out more about, should I go onto LIFO? How can I figure out how much inflation, how much my LIFO reserve would be, things like that. Well, let's first talk about how can we figure out if we're a good LIFO candidate. Well, we provide free analysis. So if you were to email us today and say, are you a good candidate? We could tell you yes or no, you should get a free analysis from us. Or you may even go out to our website and request an analysis and send us your stock status report that would allow us to give you a detailed estimate and a free report that shows comprehensive case study on what electing LIFO would mean for your company. That aside from that, you need high inflation frequency, meaning more than half of the time you should expect to have inflation. Otherwise, LIFO probably long-term will not be beneficial. You should have a certain amount of inflation. We look at 1% or greater being a good threshold. And if you were to outsource your LIFO calculation, we say, hey, $2 to $5 million of inventory is a good range, where if you have 1% inflation, maybe you want to have at least $2 million of inventory. Now, if you're doing it on your own, and we have a lot of, not the majority of our clients, but we have clients that have $500,000 of inventory and they outsource their calculation to us, but there's fees involved, and you just have to keep in mind that, you know, there's a cost that you're paying to get LIFO done, so the benefits need to outweigh those costs. You know, the critical mass for us is, if you're outsourcing, we just say 2 million is a good gauge. So once you decide or realize, hey, we are a good LIFO candidate, the second most important thing to realize is there are good and bad years to elect. So what that means is, well, is the current year a good year to elect LIFO? And so we've kind of taken a look at it and said, I'll bring up the screen here now, that we have a tool, we have a table where, if you're a company wondering if you're a good candidate or not, developed a good list, the best LIFO election candidates list. And I highly encourage you, everyone on this webinar, downloading the 3 handouts that we've provided to you, and we'll email them to you as well. But they're one of the 3 handouts here showing that, hey, cars, auto dealers, if you're on the webinar today, great year to elect LIFO. Even if you have used vehicles, you can use PPI, and the PPI inflation is between 2 and 6%, and you can use the PPI inflation on new and used vehicles. And so this list, you'll see that in many industries, there's more industries that are good LIFO candidates than ones that aren't. That between food, textiles, fuel products, chemicals, plastics, even certain lumber and paper categories, even certain metal products, machinery and equipment. There are so many good LIFO candidates out there. We've picked out the ones that are the best candidates. We have inflation multipliers, all sorts of inflation rates that you can start kind of looking at, that, hey, I'm in an industry that the last 20 years, there hasn't been a single one with deflation. So that means that I'm probably in a good industry, because I don't have to worry very much about deflation and LIFO recapture occurring. That with these resources, you on your own, you can figure out, yeah, I am a good candidate, and I should probably take a look at electing LIFO. And we have the resources to provide free analysis to quickly, within days, we're not talking weeks and months, within a week or less, we'll turn around a free analysis report. But just for, for the people on these calls not thinking about that, think, what's your prior year inventory balance at cost? What was my idea based on LIFO Pro's table of inflation rates? So let's say it's $5 million and a 10% inflation rate. We've provided you a quick way of determining what your election year benefits could be from LIFO. So in this example, you had $5 million of inventory last year, 10% inflation this year. You're talking $500,000 of year 1 taxable income from LIFO. If you had a 40% tax rate, it'd mean 200 grand of tax liability reduction from LIFO. So there are more industries that are good candidates than ones that aren't. What I'm showing on the screen now are the 15 BLS major commodity groups. And all companies can use these PPIs. The majority of our clients use the BLS indexes. So as you can see, there are more specifically, 13 out of the 15 have year-to-date inflation for the 10 months ended October. And more importantly, for are you a good election candidate, as I referenced earlier, we look at the inflation multiplier to say, A, are you a good LIFO candidate? And B, if yes, let's look at the current year inflation. So on the first row there, compare it to the 20-year annual average that's shown towards the bottom. And is your inflation multiplier at or above 1? And if yes, you're a good LIFO election candidate. And as you see here on the screen, 13 of the 15 are at or above 1. So you can kind of think about, for example, in the 1-1, machinery and equipment. Well, you're looking at an inflation multiplier of 7. So the historical average inflation's been 1.2%. Well, with 8.2% this year, you could get 7 years worth of tax deferral or savings from LIFO by electing this year, if you were to compare that to, say, a normal period of inflation. So that's why it's so important to consider using or electing LIFO in 2022. And so it's important to consider that. There's also BLS CPIs that can be used to calculate inflation. you have only retailers can use the CPI, but a lot of supermarkets use the CPI. So you're obviously going to have a great year for inflation and LIFO tax benefits. Lots of auto dealers are also now using the CPI. So you can see that there's 6% inflation in new cars and trucks. So you definitely want to consider electing LIFO in 2022. I've kind of hit on points as to, well, why would you, why can't we just wait until next year? We're starting looking at this in the current period, but we want to wait until, say, next year or 5 years from now. We'll look at this later. Well, on the left side, you elected in a year where there was 10% inflation in this example. You had 3 years of deflation out of this 10-year example, and so you had LIFO recaptured 3 times. Well, what you'll notice is you still had a big LIFO reserve, and after 10 years, you had a $4.5 million LIFO reserve. So fast forward and say you wait until next year, you had 2% inflation, $500,000 year one LIFO reserve. So the numbers in between are the same, 3% one and 1.5% deflation, and you had the same LIFO income occur in those 3 periods. But what you'll notice is you have 3 red LIFO reserve figures, meaning debit balance LIFO reserves. Well, you avoided that altogether by electing in a high inflation period, had $2.5 million higher LIFO reserve, and you had painful debit balance LIFO reserve situations in 3 of those 10 years where you were paying more in taxes from being on LIFO compared to not being on LIFO. So electing in a year like this year, you end up with a healthy LIFO reserve in the average inflation election example, but this is once in a lifetime inflation for me, where I wouldn't expect for inflation of this proportions to ever occur again in my lifetime. So if you were to ever elect, you should seriously consider electing in 2022. Lastly, before we kind of touch on key takeaways and what can you do as a company to maybe consider electing LIFO, full disclosure, you have to, for LIFO conformity purposes, show LIFO on your financial statements if you elect on your tax return. You also have to take reserves into income. You can't double dip. So if you have an LCM reserve, that would be ratably taken back into income over 4 years. If you were to convert from a C to an S Corp or have an asset sale of your business, you will also recapture your LIFO reserve. And we've discussed how deflation will cause LIFO recapture or a material substantial liquidation. So what are my key takeaways that I would like to leave you all with here today? If you're a company that's not on LIFO, you by all means should get a free analysis. You'll understand what the estimated tax benefits from electing LIFO are. It's a comprehensive case study covering all the risks and rewards of LIFO. It's customized to your particular product mix and industry, and it includes all the things that are listed here. And I know we're tight on time and we're going to go a couple minutes over, but just to reiterate the value in what a free analysis report would bring for your company, I'm going to show on the screen very quickly here. Hey, here's a LIFO election benefit analysis report. Here's what your inventories are, say at FIFO. Here's what your inflation rates are between the various different inflation indexes. And here's what your year one LIFO reserve would be. Here's what your after-tax cash savings from LIFO would be at a 40% tax rate. And we'll look at the varying inflation measurement source options. Also, look at the last 20 years worth of calculations. So we can then say, hey, out of the last 2 decades, here's how many years there was inflation. Here's what your average inflation rate over that period was. And we only ask for this year and last year's stock status or item details reports. So with 2 years worth of data, we're going to do 2 decades worth of LIFO calculations, assume a constant inventory balance and product mix, and get a very good understanding of what historically has inflation meant for your product mix. What could we say a conservative estimate is over the next 2 decades, what your LIFO reserve could grow to be. And in this example, we're looking at a 3% 20-year average. Well, under the IPIC method, you'd have 8.5%, 9%. So you're talking double, triple in the election year, your inflation and your year one LIFO reserve. So it's a comprehensive report. We make recommendations to say, did you meet our criteria to be considered a good candidate? Did you meet our criteria to be considered to be in a year where you should make a LIFO election? And we'll provide all the sub-methods recommendations where, as I referenced earlier, you're going to have a lot of different things that you need to look at. But based on us putting our hands around your simple stock status report, your perpetual detail out of your accounting system, we will do everything A to Z from an analysis perspective and give you all the recommendations, show you the detailed calculations that we made, where you can kind of see the ins and the outs of how LIFO would work, not just on a 1-year basis, but over a 20-year basis. And you can kind of see that, okay, although I may have a $2 million LIFO reserve out of the gate, but what would it look like 20 years from now? So it's a very valuable report. We highly recommend you taking one of these steps as we list here now on the screen. That, if this is something that you need to learn more about before really going to the length of getting a free analysis report, you could just decide to set up a free discovery call with us. We'll spend a half hour, maybe hour at the very tops, talking about more specifically, hey, how would LIFO work for my company? How would LIFO Pro's engagement structure or potential involvement in our LIFO calculation look like for my company? That if you're interested in any of that, we've provided this on the screen here now, where you can look at a sample item detail report, look at our LIFO election benefit analysis page, or look at what the document request list is for getting a free analysis. We actually have a form on our site where you can complete your LIFO election benefit analysis request on our website. So we highly recommend you doing so. We also have turnkey solutions that make being on LIFO as simple as possible. We have software that you can license to minimize the time spent on LIFO in-house. So I would highly recommend learning more about that at our website. And I thank you for your time today. Highly recommend getting in touch with us. We have fast turnaround time that, although we're in December here, once you get in touch with us, we're talking days, maybe a week's top to get a free benefit analysis. And we've done the majority of the work LIFO-wise once the analysis is completed. So even getting a full or final year-end calculation done, we're talking days, maybe a week tops. That it's definitely not too late to start looking at and considering making this LIFO election. We'll do all the heavy lifting and handle all the LIFO work from A to Z, where it's, okay, I need to send a perpetual item detail report or stock status report to LIFO Pro, and I receive LIFO Pro's PDF report package, and I need to make a journal entry. That we really will make it as simple as possible on an outsourcing basis. We prepare the IRS LIFO election forms as well. And we really hope to hear from any of you from this webinar. And thank you so much for tuning in. And if you have questions, feel free to reach out. That we have a fast turnaround time and welcome any questions or requests that you may have of us. So I'll kick it back to Alex if you have any closing remarks or housekeeping work.
I am currently working to respond to some of you who are still sending questions here. If you have an open question that you need a response to, please hang on. I have about 10 of them that I'm trying to type as we go along here. I'm seeing that some had a couple of issues with the poll questions. I'm taking down your name and email address so we can try to address that afterwards. But thank you all for your time. We appreciate you sitting here through our webinar today, and we hope to hear from each of you soon.
Thank you very much, Alex. And seeing that we still have a lot of people on the call as everybody's exiting, one last thing I'll share with everybody that we've looked at it already, but in case you're wondering, well, what is a LIFO report package? What is this deliverable that LIFO Pro claims to be offering? That under an outsourcing structure, you're looking at right now exactly what that would be. So here's the cover page of a LIFO Pro PDF report package. So what we will end up providing would be comprehensive documentation of your LIFO calculation, where you're going to get a current period summary report, which you'll use that to book your journal entry, which will show your LIFO reserve change amounts to make your debit and credit entries. But you're going to have that proof report that it showed the detailed steps from beginning to finish. How do you calculate your inventory at base? That for your auditors, if you're getting reviewed, it will show the step-by-step processes involved in calculating your LIFO reserve. But it'll also contain an all year's history showing from beginning to finish, from your base year and all years in between up to the current year, what your inventory at cost, what your inflation index is, what your increases and decreases at base, what your remaining layers are at base, and the same for your LIFO layers. Comprehensive documentation of that, but also complete inflation calculation documentation. So highly encourage your companies, if you're a CPA firm representing clients, to consider looking at electing LIFO, because you could get free benefit analysis report. If you're a firm that's already on LIFO, maybe you're a company that's already on LIFO, we'll give you a free review. We'll also give you a free fee quote for what electing LIFO, outsourcing it to us would be. We have very reasonable fees, and recurring fee range is in the $3,000 to $5,000 range. If you're a smaller company, it could be as low as $1,000. But we're not talking, in most cases, tens of thousands of dollars to outsource the calculation to LIFO Pro. In most cases, we're in the $2,500 to the $5,000 recurring fee range for outsourcing the calculation to us. So from a perspective of LIFO Pro is going to deliver this report package to us, it'll contain inflation calculation documentation, LIFO reserve calculation documentation. LIFO is as simple as possible. It's not a big administrative burden. The benefits always outweigh the costs for our clients. That we have a very high client retention rate, very low LIFO termination rate. I think the combination of those two factors is due to the fact that LIFO is really simple. There's meaningful tax favorability and benefits from LIFO. And so if you're a company that's not on LIFO or on LIFO, your firm representing those companies, we'll give you a free benefit analysis report, the fee quote to show you what it would cost to outsource the calculation to us. Or even if you're on LIFO, we'll give you a free sample LIFO Pro report package to show you, here's how your LIFO Pro reports would look if you outsourced your LIFO calculation to us. We provide free software demos, so you could get a free trial of our software as well, and fee quotes on outsourcing the calculation to us. So we're well over time now. I could take half a day speaking with everybody about our services, how LIFO works. If you're a firm that would love to have your own customized LIFO training session for your colleagues or firm members, or if you're a company that's just interested in having your own free discovery call, please get a hold of us. Or if you just have a simple question, email us, give us a call. We're here, and we hope to be hearing from you soon, and hope you found this webinar to be useful today. So once again, thank you very much, and we're going to wrap up the webinar. I think Alex will continue asking or answering questions that you've asked. If we cut off the webinar right now and you didn't get your questions answered, I figured
I have one more question here.
Looks like Alex has one more question, so we'll keep it open. But I'm gonna end the webinar from here. And once again, thank you for your time here today.
I believe I have responded to everyone who has sent a question and is still remaining. So if there's not any other questions to be responded to, I'll hang out for just a minute or two more here to make sure we don't have any final questions coming in. But if there is no more questions to be responded to, thank you all again for your time. We really look forward to speaking with some of you soon. And if you have any further questions after I hit end here, feel free to reach out to us directly at lifopro@lifopro.com. That is LIFOPRO at LIFOPRO.com. Hope to hear from you all soon. Thank you so much. Alrighty, we are now concluding the webinar. Thank you.